Many business owners reach a point where their successful LLC could benefit from a different tax structure. Converting your LLC to an S-corporation could save you thousands in self-employment taxes while maintaining the flexibility you love about your current business structure. Limited liability companies and S-corporations represent two different approaches to running a business. LLCs are known for their flexibility, requiring fewer formalities and offering various tax options. As your business grows, however, an S-corporation election might make more financial sense, particularly when it comes to self-employment taxes and attracting potential investors. The good news is that transitioning from an LLC to an S-Corp is primarily a tax classification change, rather than a complete structural transformation. This means that in most cases, your company will continue to function as an LLC, while being taxed as a corporation. Let's clarify what this means. When you make this change, you're not necessarily altering the legal structure of your business. Instead, you're changing how the IRS treats your company for tax purposes. By default, the IRS treats single-member LLCs as sole proprietorships and multi-member LLCs as partnerships. However, LLCs can elect to be taxed as either C corporations or S corporations. The primary benefit of S-corporation taxation is avoiding self-employment tax on distributions. As an LLC owner, you typically pay self-employment tax on all business profits. With S-Corp taxation, you only pay employment taxes on your salary, while additional earnings can be distributed as dividends, not subject to these taxes. Before making this change, you need to ensure your business qualifies for S-corporation status. The IRS has specific eligibility criteria. Your business must have no more than 100 shareholders. All shareholders must be United States citizens or residents, certain trusts, or estates. S-corporations can only issue one class of stock, meaning all shares must provide identical financial rights. And finally, certain types of businesses like insurance companies and financial institutions may not qualify. If your LLC meets these requirements, you have two main options for conversion. The first and simplest is making a tax election with the IRS without changing your business structure. The second involves converting your LLC to a corporation before electing S-corporation tax status. For the tax election approach, you'll need to file IRS Form 2553, titled Election by a Small Business Corporation. This form must typically be filed by March 15th to be effective for the current tax year. If you file later, the election will apply to the following tax year, unless the IRS grants late election relief. If your LLC doesn't meet S-corporation requirements, you may need to first convert to a corporation. This can be done through a statutory conversion, statutory merger, or non-statutory conversion, depending on your state's laws. A statutory conversion is the simplest method, available in most states. This allows for direct conversion by filing the necessary forms with your state's business registration agency. All assets and liabilities transfer automatically to the new corporation. If your state doesn't allow statutory conversions, you might need to use a statutory merger. This involves creating a new corporation and merging your LLC into it. Alternatively, a non-statutory conversion requires manually transferring all assets and liabilities to a newly formed corporation. Once your business structure is eligible, you'll need to file Form 8832 if your LLC was previously taxed as a partnership or sole proprietorship. This form tells the IRS to classify your business as a corporation. After that, you'll file Form 2553 to elect S-corporation taxation. After conversion, you'll have new compliance responsibilities. You must set up a payroll system, to process owner compensation. The IRS requires S-corporation owners who perform significant work to receive a reasonable salary before taking distributions. This is a critical requirement that the IRS monitors closely. Your tax filing requirements will change as well. S-corporations file Form 1120-S, an informational tax return, annually. You'll need to properly record shareholder distributions to avoid IRS scrutiny. Some states also require additional documentation to recognize S-corporation status. While the tax benefits can be substantial, consider the increased administrative requirements. S-corporations face stricter operational rules than LLCs, including formal shareholder meetings, minutes, and resolutions. You'll also need to maintain separate business bank accounts and financial records. Converting your LLC to an S-corporation can provide significant tax advantages as your business grows, but the decision should be made carefully. Consider consulting with a tax professional or attorney who specializes in business structuring to determine if this change makes sense for your specific situation. They can help you navigate the requirements and ensure you maintain compliance after the conversion. With proper planning and professional guidance, transitioning from an LLC to an S-corporation can be a smooth process that positions your business for continued growth and financial optimization.